Eric, thanks so much for joining us at Slush. We are live in Helsinki. It's November 2025, and you've joined the podcast, Founders and Builders. Thanks for coming on.
Thanks for having me. It's my pleasure.
If you could summarize your talk that you gave earlier today, I think it was just at midday, in one or two sentences, what will be the theme and why was it important to share?
Yeah, so I was moderating a panel with Shiv Ramji, who is the Chief Product Officer at Okta, and Oskari Saarenmaa, who is the CEO and co-founder of Ivan. And the theme of the talk was basically how to avoid your product being sort of the victim of Keynote bingo, was the term that we used, which basically means at some bigger companies, user conference or earnings call or they give a keynote presentation and what they're about to unveil is your product and they're going straight at you and essentially commoditizing you. So that was the theme of the panel discussion.
Yeah. And of course, it's not just the Keynote bingo. It's like the excuses, well, every time a foundation model builder brings out the new version of their model, is my startup crushed?
That's exactly right. And the thing that's challenging, particularly in an AI world, is that things are happening so quickly. And we frankly have seen some of that in some of our portfolio companies. And so when a foundational model does that, i.e. comes out with an extension, usually moving up market from infrastructure to application, they're usually coming with a free product, which isn't quite as good because it's not expressly built for that. But where it starts to impact the business can be in their freemium model. So the consumers may start to shift to the free product, and yours may be free as well, but they may shift to the OpenAI version of a product, for example. But yet our companies continue to thrive because what they've done is they've built an enterprise class suite that comes with a stickier customer base, comes with more security as one feature, for example, that differentiates free versus paid products. And we've seen companies thrive and adapt through that challenge. And sometimes they say, the sharpest steel is forged in the hottest fires. Well, OpenAI can certainly turn the heat up on.
Awesome. And for those that haven't heard of IVP and the work that you've done, I think you've been in the firm since 2011?
That's right.
Is that right?
Yeah.
And you've directly been involved in some investments like Coinbase, Supercell, Zynga. Could you tell us about some of the companies that you founded and what the common thread amongst those investments were? Yeah,
so IVP was founded way back in 1980. And as you mentioned, I've had the pleasure of working at the firm since 2011. And over that period of time, we've partnered with some of the world's most outstanding entrepreneurs. And I think that is the common thread because we are a multi-sector firm within technology, in many ways multi-stages. So we do look for product market fit. And so if you've defined your universe in terms of sector and also geography, we've invested quite a bit here in Europe, we do have to find some common threads, and that really does come down to some of the more qualitative aspects of what we do. And that really does involve working with entrepreneurs, making the decision to winning the opportunity to work with them. And I'd say the common threads are really entrepreneurs and founding teams that are solving real problems that are something that they typically have a tie to, but are much bigger than just themselves because you want to look for big market opportunities. And frankly, we look for motivation because statistically and probabilistically it is irrational to become an entrepreneur. The vast majority of companies fail. And even the ones that succeed find a lot of difficult challenges throughout that path. I mean, it's never a straight line. And so what you have to find and hopefully pick up in the interactions we have with founders is this almost maniacal willingness to continue to keep working on something, even when it doesn't make sense, even when it's hard. And that's ultimately what powers them to success as well. And you have to then try and tease out, why are you doing this? Because it's going to get hard.
You've invested in a few different sectors, consumer, B2B, gaming. Which are the threads you're most closely following right now? And what are the signals that you're seeing in the market?
Well, what you find in venture, like technology more broadly, is that there are sort of mini cycles within a broader cycle. And there are some times when, consumer is a hotter sector to invest in, sort of, 2011, 12, 13, when the iPhone had really just come out in the App Store, starting to flourish. And frankly, you had a ton of end user growth because it went from a couple 100 million people in the world to having smartphones to now you got 6 billion out of 7.5 billion. So that sector is cool because there's less room to grow because everyone kind of has a device already. And on the flip side, cloud adoption was a little slower to become kind of de facto. There were still a lot of big businesses that didn't trust having things in the cloud. But once that sort of tipped, that became a driver in terms of the market being ready for a lot of different cloud applications and infrastructure companies to grow very nicely. And so we're always trying to look a few years out. I mean, we're not futurists. We are, investors that do invest post product market fit. But we're trying to see what are some durable trends that will last the next 3, 5, 6 years, 7 years over the course of our investment cycle to get involved with a company.
And then taking it onto the other side of the table, when you speak with founders and they ask for your kind of input or advice or feedback on their pitch deck, for you as an investor, what is the most common bit of advice you find yourself giving founders? And I specifically want to make this relevant to the listeners, which are first-time founders or they're looking to raise their first round. Yeah, what would you say?
I wish I could say there was one particular thing. So first of all, a lot of founders don't ask for the feedback. So if you do that and take that opportunity to learn, even if someone has passed, that's a teachable moment, it's a learning moment. It's going to help you get better. So I would encourage people to ask. Now, similarly, even if you ask, it's a probabilities game. Not everyone's going to give you the feedback. But if you meet with 20 VCs and 15 pass or 18 pass, and you ask all 18 and even 5 give you some feedback, that's 5 new pieces of information that you might not have had. So I would encourage people to do that. And then what I think is interesting about the business and life is there are going to be some things that are idiosyncratic. But if, for example, you do get those 5 paragraphs of feedback, one per investor that does respond, if there's a common thread, that clearly is something you need to work on. So someone might give you 3 things, and then the 5 that show up, the one thing that shows up 5 times, you really need to fix that.
Mm-hmm. Which, in your experience for early stage founders, is the hardest problem to solve? Is it finding the right customer? Is it building the right product? Is it getting distribution?
I think the first 2 are linked, and that's more difficult. So if you have the right product, the customer will want to use it. If you find customers with the wrong product, doesn't matter. So I think those 2 are kind of inextricably linked. I do think if those 2 are working, distribution will start to take care of itself. It is so much easier today, whether you're building a consumer-facing business or an enterprise-facing business, but it is so much easier today to get product into users' hands. And in fact, for first-time founders, the bar has therefore gone up. So if you're building a mobile app and you don't have a working prototype, your seed investor is probably not going to give you money because it doesn't cost that much to build. It's very different than 30 years ago where it cost millions of dollars just to, because you didn't have a cloud, so you had to buy your own servers. You couldn't work remotely, so you had to take an office lease. It costs way less money to get started, so the bar is higher in terms of what people expect when they're willing to write those first checks, which, by the way, is not what we do, but talking to friends who are in that space, it's clear that their expectations have changed.
We just spoke about how to approach the kind of first meeting and look for feedback from investors, but how would you think about running a fundraising process if you could take yourself onto the other side of the table, knowing what you know? And I think, I was in a conversation just a couple of hours ago with someone that said, the best thing is to get a few great super angels early in your round that can be this kind of funnel or pipeline into the bigger ticket investors that maybe come in once you have a lead. How would you be thinking about constructing a round?
I'm speaking from second-hand experience then, because at that stage, it's typically not where IVP invests. But I think that's an approach. A lot of times, the earlier you go, notwithstanding the comments I made about having some kind of minimum viable product, the earlier you go, the more the decision is based purely on the people telling the story and the story that you're telling. And so the more opportunities you have to tell that story, the more that actually benefits you. That said, I think as you evolve in your journey, I actually think a CEO's job always includes some percentage of investor relations. Not because you're always raising money, but because part of your job as a CEO is to manage and mitigate risk. And a risk to any given startup company that isn't profitable is running out of money. So you want to mitigate that risk. And on the positive side of that, when you make these investment decisions and decisions to take on an investor on both sides, today that's 5, 6, 7, sometimes 10-year decision. You shouldn't make those decisions under the gun. I think no one really wants to make those social decisions with time pressure like that. And so I would also recommend you spend 5, 10% of your time over a broader horizon, but making sure you're keeping relationships warm. It allows investors to get to know you better, see your ability to execute, and frankly, you get to see whether the investor can deliver on the help that they promise. Because I know that when we're meeting with companies and building those relationships, we make an offer to help, and we should be called on it if we actually don't follow through. And that's a big signal in both directions.
Eric, as an investor, and this is my final question, I'd love to get your thoughts on this. So if you could wind back 11 years, before you joined the current firm that you're at, and you were to give yourself one piece of advice, what would that be?
Take more risk. There's an old saying in the venture business, which is the most you can lose on any given investment is what you put in, but the most you could not make is infinite. And I think all of us as investors that have been doing this long enough, we're going to make mistakes. And yes, it hurts if you lose some or all of your money on investment, but when you see something that you could have done at X price, and for some reason, ABC reason, you chose not to, and that thing takes off, that actually really hurts. Because you're never going to root for someone to fail. Like, I don't want to feel validated that I passed on someone and then the company didn't work out. That gives me no pleasure. It actually makes me excited and happy for this entrepreneur that I know is working so hard that their company becomes successful. But then I reflect on, wow, what did I get wrong that I didn't see, so I can try not to make that same mistake the next time. So that comes, and then if you take more risk, you probably mitigate the chance of that happening, that you regret something that goes.
And that regret that you have to live with, because for as long as the company is alive and growing, it's like it's like shorting a company that's rising in stock, right?
It's a little bit like that. It's a little bit like that. But the good news is we can always invest in a subsequent round, which we've definitely done sometimes, but better to get it right the first time when it's going to be, a franchise household name.
Eric, thanks so much for joining us on the podcast.
Thanks for having me.